Part 2, more issues on project cash flow. First issue is about changing net working capital. US GAAP, the accounting rule in the United States, requires sales recorded when made, not when cash is received. And the cost of goods sold recorded when the corresponding sales are made, whether supplier paid yet or not. It means that there should be some receivables and payables which are not collected or paid yet. Cash flows are not same as revenue and cost. Therefore, operating cash flows cannot handle this issue. Additionally, before any cash is collected, we need to buy inventory and materials to support sales. By looking at changing net working capital, we can incorporate the increased investment in receivables and inventory that are necessary to support additional sales. Because we look at changes in net working capital and not just current assets, we also incorporate the increase in our payable accounts that partially pays for the investment in inventory and receivables. Next issue is depreciation. We know that depreciation is not a cash item, but the amount of depreciation is related to the cash flow since it decreases taxable income, lowering taxes. From this reason, we actually need to use depreciation method that IRS requires in capital budgeting decision. The amount of tax savings from depreciation is called depreciation tax shields, and it is simply depreciation expense times tax rate. One of the typical depreciation methods in financial accounting is just evenly depreciating to salvage value, which is estimated market value at the end of the lifetime of an asset. So annual depreciation equals to initial cost minus salvage value divided by number of years. So from our example of shark attractant, it will be $90,000 minus 0 divided by 3, $30,000 per year. Now in final year of the project, we will collect cash by selling the asset in the project. Since we receive cash, we will have to pay tax. So after tax salvage value equals to the before tax salvage value times 1 minus tax rate. Our example again, after tax salvage value is simply 0 because salvage value itself is 0. The issue here is very few assets are depreciated straight line method for tax purposes. So what is the depreciation method that IRS requires? It is called Modified Accelerated Cost Recovery System, MACRS, MARCS. Every asset is assigned to a particular class, such as 3-year, 5-year, 7-year, etc. As shown in the table, annual depreciation rate is predetermined. And annual depreciation equals to cost of the asset times this annual depreciation rate. It eventually depreciates to 0. Now, we have another issue here. Salvage value may be different from book value of the asset. If so, there will be tax issue. According to the tax code, IRS charges taxes on the difference between salvage value and book value. And this difference is called the ordinary gain. If book value is greater than salvage value, which means you have ordinary loss, then you will save taxes. From our example, let's assume that an equipment is assigned to 3-year class. and salvage value equal to 0. You can use embedded Excel spreadsheet. So let's click it. Book value is initial cost and accumulated depreciation. So we need to get the each year depreciation expense from year 1 to 3, which is the depreciation rate times initial cost $90,000 for 3 years. Then you can get the ending book value. So each year depreciation is copied from here. And the ending book value equals the beginning book value minus the depreciation expense each year. And the beginning book value next year will be ending book value last year. So your ending book value will be $6,669. Now we know that there's a pre-tax salvage value $0, so there you may think that there's no cash flow at all, but there is actually cash flow because of difference between these two. So pre-tax salvage value is equal to 0, and ending book value equals to $6,669. Then you have actually ordinary loss. If you have loss, then it will be recorded in your income statement, which lead to save your taxes by the amount of loss times the tax rate. So you can save for 1,449 cents tax savings. Then after tax salvage value will be pre-tax value minus your taxes. So in this case, you can increase cash flow because you save taxes. Total $1,400.49 will be your after-tax salvage value. Package 2. A firm is looking at a new equipment with installed cost of $438,000 each year. It will be depreciated by Mark's 5-year class, and the salvage value is $69,000. If the tax rate is 21%, find an after-tax salvage value. You can use an Excel embedded Excel spreadsheet or Package 2 spreadsheet of Chapter 9 Excel template posted on Moodle. Please find it. Now let's use Excel. You can double click this embedded Excel template, or you can just directly bring the Package 2 spreadsheet from the Chapter 9 template files posted on Moodle. So again, initial cost $438,000. You have Mark's 5-year class percentage for 5 years. So each depreciation, annual depreciation will be the initial cost times depreciation rate from year 1 to year 5. Then you have depreciation amounts from year 1 to year 5. You can get ending book value equals to beginning book value minus depreciation. And next year ending book value will be, beginning book value will be ending book value previous year. And copy everything. Then you can get $25,220.80 ending book value. because pre-tax salvage value is $69,000. Now you receive cash this much, and ending book value is $25,220.80. You have ordinary gain. The amount of ordinary gain is $43,771.20. Then you have to pay tax on this gain. Gain times tax rate 21%, $9,191.95 will be the taxes you have to pay. So after tax salvage value will be pre-tax salvage value. That's the cash you receive by selling this equipment minus tax you pay. Then total $59,808.05. Okay, this is end of the chapter 9. You should practice a lot. There will be another optional lecture which includes a couple of examples. Although it is not required, it should be a good idea to take this lecture since solving example is the best way to practice. Thank you for watching and see you guys soon.